Attention, everyone. US economy is on the brink of a shakeup. The interest rate spread has surged to a 7-year high. Tech giants and Wall Street firms are slashing jobs en masse. And the social security system is hiding millions of phantom retirees. The recession alarm for 2026 has been sounded. Is this just a cyclical adjustment or a systemic collapse? What economic pitfalls lie beneath? Today, we'll take an in-depth look at the ins and outs of this storm, and by the end, you'll understand just how significant its impact will be on us. The risk of a U.S. economic recession is mounting, and the job market is taking a severe hit. According to the latest assessments from authoritative institutions such as the Congressional Budget Office, the probability of the U.S. economy slipping into recession in 2026 is facing significant upward pressure, with relevant warning signs gradually emerging. This judgment is not a mere trend prediction but a comprehensive analysis based on a range of core economic indicators. In terms of GDP growth, the U.S. quarterly year-on-year GDP growth rate has remained below 2% for 3 consecutive quarters in 2025, with the third quarter of 2025 posting a meager 1.2%, the lowest level since the second quarter of 2023, among specific sectors. The service industry has seen the most pronounced slowdown in growth. The consumer sector, the backbone of the U.S. economy, has also shown signs of weakness. In November 2025, total U.S. retail sales fell 0.8% month-on-month, marking the third monthly decline of the year. Sales of non-essential consumer goods, including catering, entertainment, and apparel, plummeted by 1.5%. While the core PCE price index has retreated from its 2022 inflation peak, it still stood at a relatively high 3.1% in December 2025, significantly exceeding the Federal Reserve's 2% inflation target. This indicates that inflationary pressures have not fully dissipated, and the erosion of household purchasing power by rising prices persists. More crucially, data released by the Institute for Supply Management (ISM) shows that as of December 2025, the U.S. manufacturing PMI has remained below the boom-bust line for 10 consecutive months, with the December 2025 reading hitting 47.9, a new low since October 2024. Among its sub-indices, the new orders index, production index, and employment index dropped to 45.3, 46.8, and 45.1 respectively, all lingering in deep contraction territory. Industrial output data is equally grim. Since the second half of 2025, U.S. industrial output has recorded 3 month-on-month declines, with a 0.6% drop in November. Output of durable goods manufacturing fell by 1.2%, with production activities in key industries such as automobiles and machinery slowing markedly. These indicators together form a clear warning signal of an impending recession. Notably, the current downward economic pressure is not a localized fluctuation in a single sector but a simultaneous slowdown in both manufacturing and services. This dual-engine slump has further heightened the uncertainty of an economic recession and significantly increased the difficulty of policy adjustments. Accompanying the recession risk is a large-scale structural wave of layoffs, with middle-class jobs continuously disappearing, shattering white-collar workers' perception of career stability. The positions being cut are not low-skilled manual labor roles as traditionally perceived, but are concentrated in high-value-added fields such as technology R&D, financial analysis, and project management roles once regarded as the stable cornerstones of the middle class, now targeted for corporate cost optimization. The spread of the layoff wave has followed a clear path. It initially emerged among Silicon Valley tech giants. Since 2024, companies like Amazon, Google, and Microsoft have successively launched layoff plans. Between May and July 2025 alone, Microsoft laid off approximately 15,000 employees, accounting for over 6% of its global workforce, with cuts spanning core business units including cloud computing and AI R&D. In January 2024, Amazon confirmed it would lay off around 200 employees in its North American stores division, covering core businesses such as private labels and the Prime membership program, before cutting another 300 roles in its advertising business during the second quarter of 2025. Google also made headlines in April 2024 for laying off hundreds of employees in its Android and Pixel smartphone divisions, further expanding the cuts in 2025 to eliminate roughly 800 positions in its search algorithm team and enterprise services department. The layoff wave then spread to the startup ecosystem in Austin, Texas. Tech startups there, squeezed by a tighter financing environment and underwhelming profitability, have joined the layoff spree, with an average downsizing rate of 15% to 20% per company. According to statistics from the Austin Technology Council, in the first half of 2025, more than 300 tech startups in the Austin area implemented layoffs, cutting over 12,000 jobs in total. Startups focused on emerging fields such as artificial intelligence and blockchain saw the highest layoff rates, with some even shutting down entirely due to their inability to secure new funding rounds. Next, financial institutions in Manhattan, New York, were not spared. Investment banks, hedge funds, and other firms, grappling with heightened market volatility and declining trading revenues, cut positions for analysts and traders. Since 2025, several major U.S. financial institutions have launched layoff initiatives. JP Morgan Chase cut approximately 1,000 employees in February, spanning retail banking and investment banking divisions. In early March, Bank of America's investment banking arm eliminated 150 junior positions. Morgan Stanley planned to lay off around 2,000 employees by the end of March 2025, accounting for 2% to 3% of its total workforce. And Goldman Sachs intended to cut 3% to 5% of its staff during its annual performance review process in the spring of 2025. Data from Integrity Research shows that compared to the same period in 2024, layoffs on Wall Street surged by 91% in February 2025, with no new job openings reported at investment banks and brokerage firms that month, indicating that the financial sector job market has entered a contraction phase. The uniqueness of this layoff wave lies in its structural nature. Unlike temporary layoffs during previous economic cycles, most of the positions eliminated this time are being phased out due to corporate business restructuring and technological upgrades, and are unlikely to be reinstated even as the economy recovers. Industry data reveals that the tech sector has been the hardest hit. Between 2024 and 2025, major U.S. tech companies cut more than 100,000 jobs in total, with technical roles such as software development and data processing accounting for over 60% of the layoffs. While the scale of layoffs in the financial sector is smaller than in tech, the impact is more far-reaching. Most of those laid off are senior professionals with years of industry experience. Their departure has not only disrupted their personal career development but also led to a loss of core business expertise within their respective institutions. The deterioration of the job market has triggered a chain reaction, with the labor force participation rate edging lower. As of December 2025, the U.S. labor force participation rate stood at 62.2%, a 0.3 percentage point drop from the same period in 2024. Among this group, the participation rate of middle-aged white-collar workers aged 35 to 45 has seen the sharpest decline, falling by 1.2 percentage points compared to previous years. Many in this demographic, facing mounting employment pressure, have chosen to exit the labor market early, shifting to part-time work or entrepreneurship. Meanwhile, although the unemployment rate has not spiked sharply, standing at 3.8% in December 2025, still relatively low, a growing number of workers are being forced into job transfers, reduced hours, or part-time roles, leading to a significant decline in actual income levels. According to data from the U.S. Bureau of Labor Statistics, the average hourly wage for U.S. white-collar workers rose by 2.1% year-on-year in 2025, lagging behind the 3.1% increase in the core PCE price index, resulting in a 1% year-on-year decline in real income. This marks the third consecutive year of falling real income since 2023. Even more concerning is the growing financial vulnerability of the U.S. middle class. Federal Reserve survey data shows that only just over 60% of U.S. adults can access $400 in cash to cover emergency expenses. 24% have no emergency savings at all. and another 30% have insufficient savings to cover 3 months of basic living costs. Volatility in the job market is further exacerbating this predicament. Many middle-class families who have lost their stable income sources have been forced to dip into retirement savings or accumulate credit card debt to maintain basic living standards. In 2025, the U.S. consumer credit card delinquency rate rose to 3.2%, an increase of 0.8 percentage points from 2024 and the highest level since the early stages of the COVID-19 pandemic in 2020, profoundly altering the living conditions of the U.S. middle class. Quantitative easing implemented during the pandemic has planted deep-seated risks, spawning to major long-term consequences. To mitigate the economic impact of the COVID-19 pandemic between 2020 and 2021, the Federal Reserve launched an unprecedented quantitative easing QE policy. According to Federal Reserve balance sheet data, its securities holdings stood at $4.37 trillion at the end of March 2020 and ballooned to $8.27 trillion by the end of 2021. During this period, monthly purchases of U.S. Treasuries and mortgage-backed securities peaked at $120 billion, representing a total expansion of over $3.9 trillion in QE-related assets. A flood of liquidity into the market directly drove a sharp rise in financial asset prices, propelling the U.S. stock market and real estate sector into a period of bullish growth. The S&P 500 index surged by over 70% between March 2020 and December 2021, while the median U.S. home price jumped from $280,000 in March 2020 to $365,000. In December 2021, a staggering increase of 30.4%. While this policy stabilized the economy in the short term, it left behind profound and lasting risks, giving rise to two major aftershocks that continue to shape the long-term trajectory of the U.S. economy. The first aftershock is the significant vulnerabilities within the U.S. Social Security system, coupled with a growing number of individuals exiting the labor market early due to rising asset prices, disrupting the normal rhythm of employment and consumption. Under normal demographic and employment cycles, working-age individuals typically follow a predictable pattern of work, save, consume to plan their careers and retirement. However, the Federal Reserve's pandemic-era QE policy, which drove up asset prices, allowed some near-retirement individuals to cash out their assets early and choose retirement. While there is no authoritative data to confirm the exact size of this group, speculated to be around 2.5 million, its impact on labor supply is undeniable. U.S. Bureau of Labor Statistics data shows that between 2021 and 2023, the labor force participation rate for individuals aged 55 to 64 declined by 1.5 percentage points compared to pre-pandemic levels, with the highest exit rates observed among those holding stocks, real estate, and other assets. This trend has directly led to labor shortages in certain industries and exacerbated the financial strain on the Social Security system. Even more alarming is the severe data distortion plaguing the U.S. Social Security system. In February 2025, Elon Musk released materials from the U.S. Social Security database revealing that over 20 million individuals aged 100 or older were registered as receiving pension benefits, including more than 11 million recipients over the age of 120, with some records even listing individuals aged 360. In stark contrast, U.S. Census Bureau data shows that in 2020, the total U.S. population was approximately 331 million, with only just over 80,000 people aged 100 or older. This massive discrepancy not only exposes critical management flaws in the Social Security system but also risks distorting economic statistics related to retirement, further amplifying potential risks in economic operations. The flaws in the Social Security system have also triggered more severe fiscal problems. Two scholars from the Cato Institute, a U.S. economic think tank, published an article on December 29, 2025, arguing that the ballooning cost of Medicare for the elderly has become the primary driver of the U.S. debt crisis and will be the largest source of U.S. fiscal gaps over the next 70-plus years. The scholars pointed out that the growth rate of U.S. Medicare spending is outpacing GDP growth, and this trend is becoming increasingly pronounced. Without reforms to the U.S. healthcare system, Economic growth alone will be insufficient to resolve this issue. The scholars outlined a range of factors driving the accelerating expansion of Medicare costs. Medical technological advancements and longer life expectancies resulting from economic development have undoubtedly added pressure. But the root causes lie in the severe resource waste stemming from loopholes in the US Medicare system and the failure of relevant governance mechanisms to control costs effectively. At a deeper level, the design of the entire US social security system is fundamentally flawed. It's relief-heavy. Prevention-light structure has created a vicious cycle. Rising poverty gives increased tax burdens gives further poverty. The US social security system is weak in preventing poverty. Exorbitant medical costs, housing prices, college tuition fees, and legal expenses have pushed many Americans into poverty or put them at severe risk of it. Soaring medical bills, rent, tuition, and legal fees drive up poverty rates. The US government is forced to raise taxes on those not yet impoverished to fund more relief programs. This, in turn, pushes more people into poverty due to heavier financial burdens. On the other hand, as government spending on poverty relief increases, fiscal pressures mount, leading to further cuts to public welfare programs such as public pensions. These cuts then exacerbate poverty levels, creating a double vicious cycle that continuously raises the poverty threshold. The second aftershock of pandemic era. Key is the drastic volatility of US dollar liquidity and structural tensions in the money market. In June 2022, to combat high inflation, the Federal Reserve launched a quantitative tightening QT policy, gradually reducing its holdings of US Treasuries and mortgage-backed securities. The monthly reduction cap was set at $47.5 billion from June to August, before being raised to $95 billion in September. In June 2024, the monthly reduction cap was lowered to $45 billion, and further reduced to $38.5 billion in April 2025. This process has been a key driver of tightening liquidity in the US money market. According to Federal Reserve data, as of November 19, 2025, the Federal Reserve's holdings of US Treasuries had dropped by 27.4% from their June 2022 peak, while MBS holdings had fallen by 24.5% from their April 2022 peak. This led to a 26.9% decline in total Federal Reserve assets from their peak to $6.56 trillion. Contraction on the asset side inevitably translates to contraction on the liability side and a marginal decline in financial system liquidity. Since 2025, liquidity in the US money market has shifted from relatively ample to periodically tight, primarily reflected in rising volatility and financing costs in the US repo market. Despite the Federal Reserve entering an interest rate-cutting cycle in 2025, lowering rates by 25 basis points each in September and October in an attempt to drive down money market rates, the tight liquidity situation has not been effectively alleviated. Since September, tensions have intensified, with the Secured Overnight Financing Rate SOFR, a comprehensive measure of US repo market rates consistently exceeding the effective federal funds rate FFR. Because the repo market encompasses a broader range of participants and demand for secured financing tends to surge during periods of liquidity stress, SOFR often moves ahead of EFFR, making the spread between the two a sensitive indicator of US dollar liquidity conditions. A significant widening of the SOFR-EFFR spread typically signals mounting liquidity pressure in the money market. In October 2025, the SOFR-EFFR spread widened further, peaking at 36 basis points on October 31st, the highest level since October 1, 2019. The magnitude and persistence of this spread have surpassed the liquidity stress triggered by the COVID-19 pandemic in March 2020, and are only less severe than the US dollar liquidity crunch seen in September 2019. Since November, the spread has narrowed but remains elevated, averaging 9 basis points daily as of the 21st, compared to just 1 basis point daily in August, indicating that liquidity stress has not fully subsided. Tight US dollar liquidity has also spilled over from the repo market to the banking system. Since September 22, 2025, the spread between the EFFR, a measure of unsecured interbank financing costs, and the interest on reserve balancers IORB has continued to narrow, falling to minus 2 basis points on November 20th, the lowest level since July 2021. This shift reflects that liquidity pressure in the repo market has reduced available interbank lending funds and eroded bank reserve adequacy. The surge in usage of the Federal Reserve's Standing Repo Facility (SRF) further corroborates this tightness. Established in July 2021, the SRF is designed to support the effective implementation of monetary policy and maintain market stability by providing overnight liquidity to eligible market participants, including primary dealers and depository institutions. Since 2025, 2 rounds of significant increases in SRF usage have occurred amid tighter U.S. money market conditions and rising repo rates. From April 15th to June 5th, 2025, and from October 15th to November 17th, 2025, average daily SRF usage reached 11.5 billion and 6.5 billion, respectively, compared to near-zero usage during periods of ample liquidity. On October 31st, daily SRF usage surged to $50 billion, setting a record high since the facility's launch. Notably, the U.S. government's debt ceiling hikes and government shutdowns have further exacerbated short-term liquidity stress through their impact on Treasury General Account (TGA) fund flows. Historical data shows that when the U.S. government slows debt issuance due to debt ceiling concerns and draws down TGA funds, this process effectively injects liquidity into the market, to some extent delaying the onset of money market tightness in 2025. The TGA balance stood at a high of $818 billion on February 2, 2025, before declining toward the $300 billion mark after the U.S. debt ceiling was raised in July 2025. The Treasury Department resumed Treasury issuance to rapidly rebuild the TGA balance. Concurrently, a government shutdown that began on October 1, 2025, due to a fiscal budget impasse restricted government spending. As a result, the TGA balance skyrocketed from $311.1 billion on July 9 to $983.9 billion on October 29, representing a $672.80 billion outflow from the market and exerting a significant liquidity drain on the money market. Combined with heightened month-end funding demand from non-financial corporations and financial institutions, these factors ultimately led to marginal liquidity tightening in the U.S. repo market since September and an acute liquidity crunch at the end of October, which drove the SOFR-EFR spread to surge. Under the dual influence of Federal Reserve QT and U.S. fiscal factors, balances in the overnight reverse repurchase on RRP facility and bank reserves have declined sequentially, further exacerbating liquidity stress. Between 2023 and September 2025, the reduction in Federal Reserve liabilities corresponding to the decline in total assets was primarily absorbed by the on-RRP facility. The on-RRP balance stood at $49 billion at the end of September 2025, a drop of $2.5 trillion from the end of 2022, while bank reserve balances remained broadly stable between $3.1 trillion and $3.4 trillion during the same period. The on-RRP balance adjusted first because it acts as a liquidity buffer in the money market. The on-RRP rate serves as the floor of the Federal Reserve's interest rate corridor. When repo rates rise, funds accumulated in the on-RRP facility flow into the repo market to ease liquidity conditions. As the on-RRP balance nears zero, the market loses this buffer mechanism, forcing repo rates to rise further to attract capital inflows. Meanwhile, the Federal Reserve's balance sheet continues to shrink under QT, and the contraction of liabilities is ultimately reflected in changes to bank reserves. Since September 2025, bank reserve balances have continued to decline, falling below the $3 trillion mark and hitting a recent low of $2.83 trillion on October 29, returning to levels last seen in the fourth quarter of 2020. Even more critically, the Federal Reserve's SRF has failed to fulfill its intended role, emerging as a structural factor contributing to heightened money market rate volatility. The Federal Reserve positions the SRF as a backstop source of market financing. Theoretically, any institution eligible to use the SRF should not borrow overnight funds at a rate higher than the SRF rate. In an ideal scenario, the SRF should curb upward pressure on repo rates and their transmission to the federal funds market. thereby ensuring the stable operation of money market rates. However, in practice, the SRF has not been fully utilized. Information from the Federal Reserve Bank of New York indicates that despite increased frequency of SRF usage in recent months, a significant number of repo transactions in the market are still conducted at rates higher than the SRF's minimum bid rate. Analyses suggest three main reasons why the SRF has not lived up to expectations. Prolonged period of ample liquidity has created a stigma effect for institutions using the SRF. Resorting to the facility signals potential liquidity problems to the market, leading institutions to prefer more expensive alternative financing channels. Second, the SRF's operational procedures and eligibility requirements are relatively stringent, making it inaccessible to many small and medium-sized financial institutions that cannot meet the participation criteria. Third, market participants have limited understanding and experience with the SRF tool, making it difficult for them to respond quickly during sudden liquidity stress events, thus undermining the tool's timeliness. Tight US dollar liquidity and structural deterioration in the job market have intertwined, further amplifying downward pressure on the US economy. Rising corporate financing costs have squeezed profit margins, while a weak job market has eroded household purchasing power. Sluggish consumer demand, in turn, has weighed on corporate revenues and investment willingness, creating a vicious cycle. Rising financing costs gives corporate layoffs, gives declining consumption, gives worsening corporate profitability, gives further layoffs. The ongoing escalation of this cycle has pushed the U.S. economy at risk of stagflation, a combination of slowing economic growth and persistent inflationary pressures. This predicament has not only left the Federal Reserve caught in a monetary policy dilemma but also posed severe challenges to U.S. fiscal policy. From a fiscal policy perspective, the U.S. government's mounting debt burden has limited its ability to stimulate the economy through expanded spending. According to U.S. Treasury data, as of December 2025, total U.S. federal government debt had exceeded $38 trillion, accounting for 135% of GDP, a record high. The massive debt load has driven a continuous increase in U.S. government interest payments, which reached $1.2 trillion in 2025. Accounting for over 15% of total fiscal spending and emerging as one of the fastest-growing items in the federal budget. In this context, if the U.S. government attempts to stimulate the economy through expanded fiscal spending, it will inevitably push debt levels higher and exacerbate debt risks. Conversely, fiscal austerity would further suppress economic growth and worsen the job market downturn. From a monetary policy perspective, the Federal Reserve is also caught between the need to cut rates to stimulate the economy and the imperative to contain inflation. The current core PCE price index remains at a high of 3.1%, significantly exceeding the 2% inflation target. Excessive rate cuts risk triggering a resurgence of inflation and further eroding household living standards. Conversely, maintaining current rates or implementing gradual cuts would fail to effectively alleviate high corporate financing costs and a weak job market, making it difficult to halt the economic downturn. While the two rate cuts implemented in September and October 2025 have somewhat eased market liquidity pressure, they have not addressed the economy's structural problems at their root, leaving the risk of a U.S. recession firmly intact. The complex and volatile global economic environment has further heightened uncertainties for the U.S. economy in recent years. Factors such as global supply chain restructuring, escalating geopolitical conflicts, and divergent policies among major economies have interacted to exert a significant impact on U.S. import and export, trade and overseas investment. In 2025, the U.S. goods trade deficit widened to $950 billion. A 5% increase from 2024, with deficits against key trading partners such as China and the European Union expanding to varying degrees. In terms of overseas investment, amid slowing global economic growth and rising geopolitical risks, U.S. corporations' willingness to invest abroad has declined. U.S. outward foreign direct investment (FDI) fell by 8% in 2025 compared to 2024. A trend that has not only impacted the overseas revenues of U.S. companies but also hindered the recovery of the global economy. The deep-seated problems of the U.S. economy are also reflected in regional development imbalances. Core economic hubs such as Silicon Valley and Manhattan, New York, leveraging their advantages in technology and finance, have maintained a degree of economic vitality. However, many regions in the U.S. Midwest and South are grappling with severe challenges, including industrial hollowing out, insufficient job opportunities, and population loss. According to U.S. Department of Commerce data, in 2025, GDP growth in the U.S. East Coast and West Coast regions reached 1.8% and 1.5% respectively, while growth in the Midwest and parts of the South stood at only 0.5% and 0.8%. The widening gap in regional economic development has not only exacerbated domestic social divisions in the U.S. but also further eroded the overall resilience of the U.S. economy. Faced with a series of severe economic challenges, the U.S. government and corporations have implemented a range of response measures, but their effectiveness has been limited. The U.S. government has rolled out a series of industrial policies, including the CHIPS and Science Act and the Inflation Reduction Act, aiming to drive the development of high-end manufacturing sectors such as semiconductors and new energy through government subsidies and tax incentives, create more jobs, and mitigate the problem of industrial hollowing out. However, the implementation of these policies has been constrained by factors such as fund disbursement delays, technological bottlenecks, and global supply chain disruptions, making it difficult to achieve significant results in the short term. As of December 2025, only $15 billion of the $52 billion in subsidies allocated under the CHIPS and Science Act has been disbursed, with investment and expansion plans by relevant semiconductor companies progressing slowly. At the corporate level, tech giants and financial institutions have increased investment in emerging technologies such as artificial intelligence and cloud computing, seeking to enhance core competitiveness through technological innovation and open up new profit growth points. However, technological innovation is characterized by long cycles, massive investment requirements, and significant risks posed by technological bottlenecks and market uncertainties. As a result, it cannot serve as a primary driver of economic growth or a solution to employment pressure in the short term. Meanwhile, some companies have attempted to mitigate the impact of the domestic economic downturn by optimizing supply chains, reducing operational costs, and expanding into emerging markets. Nevertheless, amid slowing global economic growth and rising geopolitical risks, the effectiveness of these measures has been constrained. Looking ahead, the development of the U.S. economy remains fraught with uncertainties. If the Federal Reserve can strike a balance between stimulating the economy and containing inflation, using prudent monetary policy adjustments to ease market liquidity pressure and reduce high corporate financing costs, if the U.S. government can effectively implement relevant industrial policies, drive the development of high-end manufacturing, narrow regional economic disparities, and alleviate the weakness of the job market, and if the global economy can gradually recover, geopolitical conflicts can be effectively mitigated, and global supply chains can stabilize, then the U.S. economy may avoid a deep recession and achieve moderate growth. However, if these issues remain unresolved, the U.S. economy is highly likely to slip into recession in 2026, exerting far-reaching impacts on the global economy. The deep-seated problems plaguing the U.S. economy are the result of the combined effects of long-term institutional imbalances, policy mistakes, and changes in the global economic environment. Resolving these issues will require sustained efforts and systemic reforms. Whether it is improving the social security system, coordinating monetary and fiscal policies, optimizing the industrial structure, or promoting balanced regional economic development, it will demand the joint efforts of the U.S. government, businesses, and all sectors of society. For the global economy, as the world's largest economy, the stable development of the U.S. economy is crucial to the recovery of the global economy. The international community also expects the U.S. to adopt responsible economic policies to promote the healthy development of the global economy.